Hello everyone. Welcome back to our channel. Today we'll explore a fundamental topic in the energy market: the impact of excess oil on Donald Trump's promises regarding fracking during his second term. This analysis is based on the image you're seeing on screen, with the source located at the bottom. Throughout the video, we'll discuss how this dynamic could influence the energy production in the United States and global oil prices. To understand the present, it's important to know how we got here. The United States became a global leader in oil production thanks to the rise of fracking, a technology that revolutionized the energy industry over the past 2 decades. This method allowed producers to access vast reserves of oil and gas trapped in shale formations, driving production to record levels. The fracking boom not only transformed the energy market but also had profound economic and political implications. Over the last decade, the U.S. transitioned from being a net oil importer to a key exporter. However, this growth also brought challenges: price fluctuations, environmental tensions, and now a global oversupply threatening to destabilize the market. Donald Trump has made fracking a central piece of his energy policy. During his campaign and recent speeches, he promised to reduce fuel prices by increasing production. His message has been clear: prioritize U.S. energy independence and support production companies. However, the global market reality presents significant obstacles. One major challenge is the excess oil in the market. Analysts estimate this surplus could reach 1 million barrels per day in 2025. How does this impact Trump's promises? Simply put, increasing production in an already saturated market could further depress prices, affecting producers' profitability and market stability. Additionally, many tools Trump could use to boost production, such as opening federal lands for exploration, have a long-term impact and wouldn't resolve immediate issues. The dynamic chart you're seeing on screen focuses on the positive year-on-year variations in U.S. oil production. It's important to note that the years 2015, 2016, and 2020 are not represented due to recorded declines. This highlights not only the growth periods but also the sector's vulnerabilities during certain times. Why is this exclusion relevant? Because it allows us to focus on periods where the fracking sector overcame barriers and maintained its leadership. However, it also reminds us that the industry isn't immune to market fluctuations, as seen during the pandemic-induced drop in 2020. While the U.S. faces its own challenges, other countries like Guyana, Brazil, and Canada are ramping up production. Guyana, for instance, has emerged as a new key player thanks to recent discoveries of large oil reserves. Brazil continues developing its offshore fields, and Canada remains significant in exporting heavy crude. This increase in global supply contributes to the projected surplus for 2025, creating a scenario of downward pressure on prices. According to Macquarie Group, supply could exceed demand by 2.4 million barrels per day in the first quarter of 2025, just as Trump assumes his second term. One element we can't ignore is the impact of Trump's trade policies. His focus on imposing tariffs and renegotiating trade agreements could negatively affect oil demand. A prolonged trade war with China, for example, could erode global crude demand, exacerbating the oversupply. On the other hand, fiscal incentives for the energy industry and pro-fracking policies could benefit certain producers in the short term. However, these measures would have limited scope against global market dynamics. Based on the analysis presented, we can propose several hypotheses. Lower prices. If the oil surplus persists, prices could remain low or even decline, affecting U.S. producers' profitability. Sector adaptation. Large companies like ExxonMobil and Chevron could continue increasing production due to their economies of scale, while independent producers may face significant financial challenges. Investments in innovation. To stay competitive, producers might invest in more efficient technologies to reduce costs and improve operational sustainability. Geopolitical impact. Trump's policies could create international tensions, affecting the stability of the global energy market. Another important factor to consider is the environmental impact of fracking and how regulations could influence the industry. Fracking has faced intense criticism due to its water usage, aquifer contamination, and greenhouse gas emissions. Although Trump has promised to reduce regulations to boost production, these measures could face resistance at both state and federal levels, especially in states where environmental concerns are prioritized. Additionally, international pressure to transition toward cleaner energy sources could limit long-term investments in oil and gas projects. This move toward decarbonization, driven by global agreements like the Paris Accord, represents a structural challenge for the fracking industry. While the oil surplus could be problematic for producers, consumers might benefit from lower gasoline prices and other oil derivatives. This, in turn, could stimulate certain sectors of the economy, such as transportation and manufacturing, which rely on low energy costs. However, prolonged price drops could also discourage new investments, creating risks for long-term energy security. It's a delicate balance. While consumers enjoy more accessible prices, the impact on producers could reduce the market's ability to respond to future demand fluctuations. Finally, it's crucial to analyze how the global oil landscape influences international relations. The United States has used its dominant position in energy production as a geopolitical tool, offering crude and liquefied natural gas (LNG) exports to strengthen strategic alliances. However, excess oil could reduce its influence as other major producers like Russia and Saudi Arabia seek to consolidate their market power. Furthermore, rising production in emerging countries like Guyana could alter traditional geopolitical dynamics, redistributing control over energy markets. This shift underscores the importance of diversifying the energy economy both nationally and internationally. In summary, excess oil represents a major challenge for Trump's promises on fracking. While the United States remains a leader in energy production, global dynamics and structural market limits complicate any attempt at aggressive expansion. However, the shale sector has demonstrated its adaptability in the past, and we can't rule out positive surprises. Ultimately, success will depend on producers' ability to balance supply and demand, adopt new technologies, and navigate the complexities of the global market. Thank you for staying with us until the end. I hope this analysis has been useful in understanding the complex panorama of fracking and oil in the United States. Before saying goodbye, I want to invite you to watch our next video, where we explore how the S&P 500 would have performed without the 7 magnificent stocks. The link is on screen right now. See you in the next analysis. Goodbye.